Your host here on Whissel Wednesdays. As always, if you want to get in touch with myself, any of the guests we have on the show, we would love to get you connected. We want to be your resource for anything financially related here in San Diego, whether it be real estate, whether it be mortgage, appraisals, taxes, entity formation, any of that stuff. You can always text us 619-663-7355. That's 619-663-7355. And before the break, we were talking about Zillow buying Trulia. They're these massive multi-billion-dollar companies that are out there. And I want to talk to Dave Gibbs, senior manager over at Cohn Reznick, kind of a little bit about, what are giant companies like this? Are they corporations? Are these guys LLCs? What are they?
These are definitely corporations. Anything that's going to be that big is going to be a corporation. Just because for a company that size, it's the easiest way for them to operate. If they go public, then you're going to be a corporation.
And that's a C corporation typically.
And these will be a C corporation.
So I hear a lot of stuff out there with corporations, S Corps, C Corps, all these different things. I mean, what's the difference between these?
The difference between a C Corp and an S Corp is strictly a tax thing. The foundation of it, for legal purposes, the exact same corporation. So according to the California Secretary of State, your corporation is a corporation. But for tax purposes, you can elect to be an S corporation. And an S corporation is effectively what we call a flow-through entity, meaning that the income or the loss generated by the business flows through to the shareholder. And
so businesses lose money every once in a while, Dave? Is that what I'm hearing?
Yeah, every once in a while we have some S corporations that do happen to lose money, especially early on. And
what's interesting is Zillow and Trulia that we're talking about, neither of these guys are turning profits.
Well, no, of course not. These are tech companies.
Yeah, these guys aren't turning profits, yet they're being bought for billions of dollars.
It almost seems like we're going back to the late 90s, early 2000s, where the technology companies had these insane valuations, and we're buying them based on what we think is going to happen in the next 10 years.
Yeah, see, it literally seems like that again, right?
Yeah. So the S corporation, though, does have some limitations as far as who can own it.
Okay.
Which is why a lot of times a big corporation, and when I say big corporation, I don't necessarily mean big in size of revenue and things like that, because we have some S corporation clients that, they have $75, $100 million in revenue, but the S corporation can only have a certain number of shareholders, 100.
Okay. So it's maxed at 100. Most are probably even less than 5.
Absolutely.
Right?
We have numerous S corporations really just have one shareholder. And I'll kind of get into that a little bit when we talk about the kind of choice of entity when you're starting a business.
Well, let's talk about that. So one of our listeners is getting ready to start a business. Let's say an appraisal business, for example. So again, we got Scott Martin with Pinnacle Appraisals here. Let's say Scott is just getting into the business, wants to start his own appraisal company up, and you were advising him on what entity would be ideal for him in his situation. So how would that process look of identifying what's best for him?
Absolutely. You kind of start with knowing that Scott in his appraisal business. The first thing we think about an entity setup is liability protection. It's always kind of the first thing. And so automatically people go, well, I got to be a corporation because I want to protect my liability. And sometimes what I'll say is, what kind of business are you in? Are you going to be sued for something where the liability protection of setting up a corporation, going through all the formalities of that, filing a separate tax return, filing with the Secretary of State, doing all those things, is that necessary, or could just like errors and omission insurance for like appraisal work, that kind of thing, would that protect you? And of course, I'm not a lawyer, so.
These are good questions, though.
And I'm not in insurance, but
right.
Those are the things I say. Talk to your attorney, talk to your insurance provider, and let's think about whether we really need to set up that corporation for this type of business.
Okay.
Because this type of business isn't necessarily something where you're looking to bring in investor money or anything like that. It's your job. It's your practice, and this is what you do. And so, if we don't need to go through all of that, then let's not. Let's save the tax money. Let's save the fees for preparing a separate return.
So give me some examples of some, businesses that maybe don't need to be incorporated.
So like an appraisal business.
An appraisal business, some sort of, even like a CPA. There are corporations that are CPAs. Our firm, Cohn Reznick, is what's called a limited liability partnership, which
LLP
is like a general partnership, but each partner has limited liability from what other partners do.
And I see that a lot with financial companies, LPs, LLPs, but you don't see that in a lot of other industries. So why is it that like
really
CPAs
the
and
LLP
stuff like that?
is limited to CPAs and attorneys, those sorts of businesses, just by the nature of how the.
So our California government allowed that really just for CPAs
Exactly.
and attorneys, right?
Yeah,
That's kind of
those kind of professional services. For, a similar animal to that would be an LLC for kind of the non-professional services area. And we're seeing a lot of LLCs now as far as businesses go too. Especially, this is obviously a real estate show, so a lot of real estate is in LLCs.
So when you're buying real estate, like
When you're buying real estate.
if you and I, Dave, were buying a piece of property, and say it's a 4-unit property that you and I tend to hold and manage and rent, the LLC seems to be the popular thing nowadays.
Absolutely.
Okay.
Yeah,
And why is that? What's some of the benefits?
The benefit of the LLC is, like a corporation, it gives the owners, which are called members, limited liability, so that if something happens to the property inside there, it's like a corporation, they can't go after your personal assets.
So they couldn't come after you and I in that example of
Exactly.
our personal assets, just our LLC,
Mhm.
right? That's
So
all
just
they
the
can-
assets, whatever we put in, the property itself, that could go after just, like anything else, but our personal assets are sheltered from anything like that. And with the LLC, for tax purposes, by default, if there's more than one member like we would have here in ours, it's treated as a partnership. And so with a partnership, you have just a lot of flexibility as far as how you can allocate things. It's a lot easier to get the property out. If we decide, we're not really jiving anymore as far as operating this thing, and we want to maybe go our separate ways, we can, instead of having the LLC itself sell the property and just divvy things up, the property can come out of the LLC and we can each own it as tenant in common.
Mhm.
And then you have your half, I have my half. If you want to sell your half to me or to somebody else, and there's a lot more flexibility as far as getting properties out of a partnership. In fact, I'll say this, one of the big things in the tax world is you never put a real property in a corporation.
Why is that?
Because the corporation has very kind of tax difficult ways of getting property out.
Okay.
If it's cash, it's coming out as a dividend, and this assumes a C corporation.
Right.
So if it's cash, it's coming out as a dividend. So that's where the whole, you may have heard this term, double taxation with a corporation.
Right.
That's because the corporation itself, if it's a C corporation, if it has net profits, it pays tax on that.
And
If there's-
any distributions or anything to any of the owners, they pay
Exactly.
taxes again.
Yeah, so if there's any cash left over after paying the tax and it pays a dividend out, you as the shareholder are paying tax on that dividend. So
And that's why it's an advantage to be an S corp for some corps. But in real estate, it's a better advantage if you're going to hold real estate. And if you're a young person who owns a lot of property and buys a lot of property, you might want to be putting it in an LLC versus holding it sole proprietor in your own name.
Exactly.
So I've been advised in the past that if you are a member of an LLC, and let's say you're flipping properties,
Mhm.
that there's a thing called gross receipt tax.
Yes.
So what is that?
So for California, they instituted a gross receipts fee for LLCs that do business in California. And effectively, it's regardless of if you're profitable or not, based on your gross receipts amount, you're going to pay a fee to the state. So if
Welcome
you
to California.
Exactly.
Our
So
lovely
from-
government up there in Sacramento.
If you have 0 to 250,000 of gross receipts, you don't pay anything.
How much? 0 to...
$249,999 of gross receipts, no fee.
Okay.
From 250 to 500,000, it's $900.
Now, selling that would be considered gross receipts, you're saying. So if you bought a $400,000 property and sold it the same tax year, would you think the sell of the asset, or is it just the incoming rental
It
income?
depends on the asset. If you are flipping per se, where it's not really held for investment or held where they're treating it as basically you're selling kind of inventory, then the $400,000 gross,
Part of the gross
sales
receipts.
price would
Wow.
be gross receipts. If it's a rental property that's just sold for 400, but your gain's only 100,000, then it would be the 100,000, so you might not have the gross receipts.
So how could somebody avoid that gross receipt fee?
Not be an LLC.
Okay.
There really is there's no way to avoid it.
So if you're a real estate guy who's flipping, a real estate investor out there, guy or gal.
So we get a lot of flippers that listen to the shows. I flip properties. Jason and I are going to do some flips and stuff together, I'm sure. So what's the best way, what's the best entity for somebody to
Just
hold,
in general.
to flip
We're not going to hold you
properties?
this today, but
Right.
in general. I know how CPAs think. They're
Yeah.
like, well, this and that. We're looking, we don't want to go too far here, but in general, what's the best?
I would still say the LLC, because the fee itself is, it's kind of a small price to pay to have the property in that, because.
How much of a fee is it? I don't even know.
It's $900 to, the top fee is $11,790, but that's if your gross receipts exceed $5 million. So.
Which you would have probably last year with all the
With all the
properties
gross?
you sold.
Yeah, I mean, it's crazy how that works, how, I'm not profiting that kind of money, but just the overall sales price added up. I mean, as a team last year, we sold almost $100 million in property last year. So, I mean, that stuff adds up, but not like we paid anywhere near that kind of money. But to be taxed on the actual sales price of all that stuff added up, that can definitely add up.
It can, yeah.
So there's a big myth out there too. So that's the LLC thing. I've heard a lot about people wanting to incorporate in Nevada, and that there's some advantages to that.
Yeah, and that's one of those, like you said, a myth that's kind of been around for a long, long time. You'll see the advertisements in a magazine, or you see the billboard or something like that. Incorporate in Nevada, save taxes. And it sounds great because in the pitch always is, hey, Nevada doesn't have any income tax, so you incorporate here, you're saving yourself state income tax right away. The problem with that is you have to be in Nevada to take advantage of that. The business has to operate in that state. You have to be operating the business in that state. So if you are in San Diego and you see this billboard and go, heck yeah, I'm going to incorporate in Vegas.
Sure.
Who doesn't want to go to Vegas?
Right.
But all you're doing is incorporating your business in Las Vegas. You've got a Las Vegas P.O. box or something like that.
And we have our annual shareholder meeting there in Las
Right.
Vegas.
Yeah.
But you conduct the business here in California, therefore you got to pay the taxes in California. So there's a lot of mistakes that you can make out there when it comes to this entity stuff. That's where you need an expert like Dave Gibbs with Cohn Reznick on your team. If you want to connect with Dave, shoot us a text, 619-663-SELL, 619-663-7355. We will connect you with Dave. He will help you figure out what is best for you, your particular situation, to help you accomplish all of your goals. When we get back, Dave's a Santee guy, Scott's a Santee guy, I live in Santee. I want to talk a little bit about what makes Santee unique. You're listening to Whissel Wednesdays here on KCBQ 1170.
Good job. It is hard to get so detailed,
Well, and,
and that's why I'm trying to look for general stuff, because
Yeah.
I know how